How is everyone doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. I have another great interview for everyone today. We have a great person, Danielson from the Kafafian Group, is here to join us. He's an investment banker, been doing it for a long time, and he's going to give us a lot of information on the bank M&A market. And with that being said, I'm going to bring Dave in. Dave, how are you doing today?
Joe, I'm doing great. I really appreciate you having me on your podcast.
Great. Hey, thank you so much for spending a few minutes with us today. So I alluded to the fact that we're going to be talking a little bit about bank M&A transactions and other such interesting material here. So to help guide our conversation today, I'm going to bring up a little presentation that Dave was kind enough to prepare for us. So now that we got this up, I'm going to kind of kick us off with our first couple of questions here, Dave. So let's start out with what key factors will boost M&A in 2026?
All right. Well, I think you move into the next slide. I think there are a couple key things that are coming up now. Basically, off the past year or so, I think there's a lot of pent-up demand. We have some investors looking for exits, and what investors are looking for, they're looking for exit pricing, which is higher than where banks are currently trading, and they're looking for more liquidity. And they can really only get those things through a sale. You also have succession issues. Many banks have sort of an aging executive crew or aging boards, and you have a next generation of bankers that maybe are not interested in going to what their father or mother did if their parents were executives of a bank. So you do have some succession issues because you do something we'll talk about a little bit later. Is there are good many hundreds of over 1,000 banks that are still owned by families that will be running into succession issues. You also have lower rates, which are going to impact yield marks, which is something we'll talk about later too. And these yield marks primarily hit the available for sale securities portfolio and the loan portfolio, and those were detrimental to getting deals done. I also think moving forward, we have good asset quality right now. I know there's some mention of cockroaches out there in terms of consumer lending. And there are some concerns in more of the urban areas in regards to offices, but generally asset quality has been good. As long as that stays strong, I think we'll have an uptick in M&A. And most importantly, bank stock prices. Bank stock prices have to hold up because that's what allows one bank to buy another is using their own common equity.
Yeah, no, I agree. Excellent comments there. I just have to laugh for a second because I think Jamie Dimon kind of captured the sentiment perfectly with just one, cockroaches. It's just, and it's funny how he said that in that interview, and that's just kind of, flowed throughout so many articles recently in the last week or so on news media and stuff like that. So it's kind of, he caught the sentiment of the moment perfectly. So
I think one thing he's talking about too is, are those loans done within the banking environment? Some of those are private credit loans, like outside the banking infrastructure. So, how is banks going to hold it? Banks are generally much more well capitalized than last time around, and I think they're much more diligent in their loan portfolio and their underwriting.
Yeah, I think if I was to have a little crystal ball in front of me, I would say that catchphrase, a little something called NDFIs. I think we're going to be having some deeper conversations about NDFIs over the next 6 months and about maybe how they operate, how they're regulated, certain things they're doing, maybe certain things they're not doing. So that's a side note. We won't get into all that today, but yeah, I definitely concur with you. There's a lot of things happening kind of outside of bank underwriting, outside of banks that is kind of steering a lot of that stuff that you're seeing in the media right now, or at least a lot of that stuff in the, with like Tri-Color Holdings, First Brands, all that kind of stuff. So, but let me ask you this, kind of continuing on here, if we jump to the next thing here. So how many banks are there, and why do we have so many right now? Like, how long do you think this is good that we're going to kind of roll with the number of banks that we have?
What's interesting is our banking environment was not a natural setup. If we were free of regulations, we wouldn't have so many banks. And you see in other countries, the banks are maybe measured in a handful or a dozen. We had unitary banking in this country, which basically meant when you walk down into a small town, you would see on Main Street, you'd see a bank on one side of the corner, and on the other corner, you'd see a savings bank. Mm-hmm. And that's the way it existed throughout the late 1800s and up through 1980. And as early as 40 years ago, there were 18,000 banks in the country. and was really based off a unitary banking model that was meant to protect essentially local deposits fund local loans. And that was really the premise. And then also if there was a contagion, it wouldn't spread from one bank to another. Mm-hmm. That didn't entirely work out. No. But the real decline in the number of banks came from the fact that in 1982 and 86, laws started to change. I have on the screen there, I have Pennsylvania as an example. So banks were not allowed to branch really until 1982. And, even then, could they go across county lines? And then even in Pennsylvania, full statewide banking wasn't until 1986. And then some of it was, nationwide, and branching was allowed in the 90s. But that's what really kicked off this decline. But as far as where is a steady state, probably around 3,000, because there are, again, if you look at a map of where all the banks are, they're in the very much down the middle of the country in the Midwest, and a lot of them are family owned. So they have just different reasons for being in business. And I think as long as business are good and the kids want to follow in your footsteps, those banks will stay there. So about 3,000 is probably a give or take good number to end on.
Very interesting. So how do you see the de novo activity? With a little, kind of like the change of administration, some of the perhaps laxing of some of the regulations that we're seeing out there right now. How do you think that de novo market plays out?
Well, I hope there's more de novo activity, but since the great financial crisis, I mean, back prior to the GFC, I always had on my desk, 3 or 4 de novo clients that were trying to start banks. And after the great financial crisis, that changed and pretty much went to 1 or 0. And because the capital requirements were too high and the regulatory environment was just too tough. So you are seeing some de novos now, but they tend to be very specific purpose. Like they have a reason for a niche. Yep. So they're fewer and far between. They tend to be much more well capitalized than they were in the past. But hopefully there's a uptick. But in either case, we hit, the amount of mergers we're going to potentially hit. The de novos, they don't even register as, coming close to keeping this number up.
Interesting. Yeah, it's some very good points, very interesting points that you make there with the de novos. I actually just did an episode just about a week ago covering a new startup de novo bank called Erebor, which is being primarily started by a gentleman named Palmer Luckey, who is, I'm trying to think of the name of his business. It's got a very interesting name, but basically he runs like kind of an AI defense company where he's really working with the government to create a lot of autonomous vehicles, drones, autonomous submarines, things of that nature. And he decided to start this bank, and they just got the government approval for it. They're going to begin doing a capital raise shortly, and they want to go out and target a lot of former Silicon Valley Bank customers, which I thought was really interesting. But I think that example goes perfectly to your comments of, I think if you do see a de novo, it's going to be niche. It's going to be something there to fill a very specific gap. And, Silicon Valley Bank was a bank that had a very niche business, a very niche clientele. Silicon Valley Bank was very different from any other bank in the country. So again, I have a tendency to agree totally with your assessment there that at the new de novos we see are probably going to be centered around something very specific, as opposed to maybe trying to be just a general, just a regular commercial bank or something like that.
Yeah, you don't see the bankers starting up like, we're here to raise deposits within the community and lend within the community.
Yes,
you're not seeing that anymore.
Yep. Okay, so we'll keep going on here. So do you see, I'm going to go to the next slide here. Do you see another wave of M&A coming?
Yeah. You can see in the chart there, we've had their kind of dips there. We entered 2019, I'll sort of use as the base. And you can see in 2020, when COVID hit, everybody got scared, but the banks actually performed well because the government pumped money into the economy, and, banks became flush with deposits and the credit stayed good. So when we came out of that in 2021, there was a real surge in the number of bank mergers, which then again fell when the Fed began raising rates. As rates went up, you had costs went up. It sort of introduced some uncertainty into there. And then, when you had SVB fail, as you alluded to earlier, you see that the bank mergers just really stopped off in 2023. So we basically hit another low, and it's again because of uncertainty. First it was COVID, and then it was essentially funding costs and liquidity. And then as we come out of that, as rates started easing up, or at least slowing the increase, and then started to decline, you see the number of deals go up. And so we had 123 last year, 151 now. If you annualize 151, you get about 180 deals for the year. And you can see the pricing's also improved too.
Mm-hmm. So, and again, I'm sure we're going to get into some of the reasons, the why, in a few minutes here, but you see this trend continuing into 2026. Like, say we do get 180 deals this year, you see that maybe increasing a little bit more into 2026?
Yeah, as long as the conditions sort of remain as they are, and rates come down, which I think we'll talk about later, is I think a primary function where basically the accounting marks that are been onerous on the sort of getting a deal done are going to be reduced, and I think that will contribute to bank M&A.
Okay, very good. All right, I think that's a great segue here. So let's go into our next thing here. So what is really driving the M&A pricing right now? Like I see banks under 1 billion trading at, say, less than 100%. Like, what does that mean? And then also I see kind of a bump in 2022. Like, so why did some of the banks trade higher when, rates spiked? If you could kind of go into those two separate things for a few minutes.
Yeah, well, first to your last point there, why is that blue line a little higher in 2022? What happened was that's when the Fed was raising rates. So the rise in rates created unrealized losses in banks available for sale securities portfolio, which directly hit equity of the banks. So what happened there really wasn't a bump up in the actual stock price of a bank. What happened is the denominator in the calculation fell out. So the price may have remained somewhat constant, but the tangible book value fell by a lot. So it just looks like pricing's higher. Wasn't really higher in 2022. We were kind of nervous about that. So that's why I'm showing the prices in 2019 as sort of the last normal year. And then as 2024 and 2025 is normal years. And you can see the pricing of the larger institutions trade higher. So for example, regional banks that are 50 billion and up trade at higher than a bank that's under $1 billion. Mm-hmm. And to your question of sort of what's going on, you got a bank under $1 billion in assets trading at 91% of book. So what does that really mean? That means that if they sold their assets, which are their loans and securities, and they paid back all their deposits and borrowings, they would actually be left with an amount that's less than their current equity. And that's not a great value proposition. Now, this is a median. So many of these, I think there's about 270 banks trading under $1 billion there. The median's 91. The good ones trade much higher than that. But, overall, it does show you the advantage larger banks have over smaller banks. And how this relates to mergers are, on the prior pages, we saw the median deal price was like 146. Okay, so now go back a page. So you see that the 10 to 15 billion are trading about 141% of book. Yep. So basically what happens is the simple deal math is if you trade at 141% of book, you can probably pay a little bit more than where you're trading. And so the median of deals is 146. So that kind of tracks with the way the deal math works.
Okay. Let me ask you this, because I have talked a lot on the channel about, kind of the negative AOCI in a number of banks around the country, the issue that the industry as a whole is dealing with, the unrealized losses in bank bond portfolios. That's been hanging over banks' heads now for, about, 2 years. Do you, how do banks eventually work themselves out of that situation? I mean, do you think that takes another couple years for banks to kind of finally get out of that? Or do you think it'll be, what's your thoughts on that?
We are working. There's two ways that we work our way out of the AOCI issue, the negative impact. One is time, because most of that's based off your securities portfolio. Mm-hmm. And so in 2022, people had securities portfolios of maybe 5, 7 years or more. So as time goes by, those bonds do pay off at par, and your AOCI unrealized loss will slowly melt away. The other thing too is if rates go down, the value of your bond that you hold is going to increase. So, or the discount will go away. So the two things you're waiting for are passage of time, which we're getting, and then lower rates, which looks like we're going to get.
Looks like we're going to get. We'll see.
I don't know. But
we don't know. All right. So now that we've got that established, let's go into, so why do larger banks in particular trade a little bit higher here?
All right. They trade higher. Bottom line is they earn more. They basically have more sources of revenue. They can leverage themselves up to a much greater extent, and they earn more on their capital. I mean, I didn't have that slide in here, but they do tend to hold less capital in terms of capital to assets. So they are leveraged up more. They have, better non-interest income, diversified streams. So they do earn more. And if you earn more, you can be valued at a higher value to book. So we saw on the other page, price to tangible book was higher the larger you went. And here you do see the same thing. This is earnings. The larger banks earn more. And again, you're looking at the under $1 billion, where the return on tangible common equity under 10%, which is sort of the Maginot line, the line in the sand there, where, you want to get over, you want to be 1% on assets, 10% on equity, sort of at a minimum.
Yep, exactly. All right. And then let's go into, so why do interest yield marks, basically discourage deals?
All right. So this is a example here, and I want to focus on the great parts in normal times. So if I'm a bank CEO and my tangible book value is $20, and in my mind, I want to get 150% on that 20. So I want to get $30, and that's what I have in my mind. But rates went up. This is sort of pre-2022. So what happens when rates goes up, there's a mark added in, okay? So you add a mark in for available for sale securities, and then you add another mark when you sell for loans. So what's the difference between the two? So in normal times, for a buyer, 150% of book would be, my earn back would be 3 years.
Yep.
So now the same deal, if the book value is marked down to $17, the buyer's thinking, okay, I'll pay 150%. That's $25.50. But remember, the seller CEO says, no, I have 30 in my head. Okay, well, 30 is 176% of book. If I do that deal, it's going to take me 4 years to earn that back. And the earn back analysis at the bottom of this slide basically shows you in normal times, if me as the buyer have a book value of 40, and I do this deal, I'm going to suffer dilution of $3 because of the marks and the deal expenses. So I'm going to lose $3 in dilution, which is 8% in this example. So in the example below, the EPS pickup is $1 each year. So if I lose $3 in dilution in the deal, I need 3 years to make it up.
Yep.
In the situation where we have a yield mark, you'll see I'm paying more because I had to mark down their book value based on the accounting marks that are appropriate for whatever interest rate environment there are. And since that equity is less, if I'm trying to pay the same price, it's definitely, I have a bigger hole to dig out of. So in the example on the bottom right there, you see if I have $4 dilution using the same earnings per share pickup, I would need 4 years to break even. So this is the difference from a buyer announcing a deal that my earn back is 3 years, and a buyer announcing a deal that's 4 years. And I can tell you, as a shareholder of the buyer, you're going to prefer the former, not the latter.
Correct. Yeah, exactly. And I appreciate you putting that last point in there, Dave, because I was going to say, like, hey, for the podcast audience, why would they, not necessarily be, why would another bank not be happy with the 4 years as opposed to the 3 years? So thanks for putting that in, because I think that really helps the audience kind of understand this a little bit more in terms of looking at it from that banker's perspective as to why they may or may not want to do something with a particular deal as they're, trying to evaluate these things. So
one thing you're going to see too is that to elaborate on this point further is when a buyer announces a deal, often their stock price might go down because now, oh, they're not selling, they're actually buying. So, and if you announce a deal that's, 5-year earn back, the market's going to hesitate on that. So lower number is better from the buyer's point of view from all angles.
Yep. All right. So now let's move on to, how big was the equity in 2022? And now when I say this, and you'll see on the slide here, it says AFS. That stands for Available for Sale Securities for anybody out there that doesn't know. So in a bank's investment portfolio, you have two things. You have AFS, available for sale, and you have HTM, held to maturity. So those are kind of the two buckets that most banks have in their investment portfolio, as they set it up. So with that being said here, on this slide, we're just focusing on the available for sale securities in 2022. But I'll turn it back to you for a second, Dave, to kind of guide us through this one here for a second on this slide.
When rates rise, you do not mark to market the held to maturity or the loans, okay, at quarter end. But at each quarter end, when the bank files their 10Q or their call report, what you'll see is the available for sale securities are marked to market based on whatever the interest rate environment is at the time. So what's interesting here is that in 2019, 2020, 21, you can see that there wasn't much of a mark. And AOCI can encompass all sorts of things. But for this slide, just assume that the vast majority of the AOCI mark is the available for sale securities, the unrealized loss in available securities. So when rates rose in 2022, what happened was the unrealized loss in these securities increased. And why did these regionals have such a big hit? So what happened during COVID was deposits, remember, flowed into the system. Corporations were hoarding the liquidity, consumers were holding up purchases, and the government was pouring money into the economy. So the money ended up in larger banks, typically, because there was a lot of money coming into the system. And that money is burning a hole in your pocket, earning nothing. So the thought is you invest them in securities, which turned out to be a short-lived good idea, because once rates went up, so the unrealized loss on these securities increased dramatically. And you can see for these regional banks, they lost 23% of their equity in this. This is the median. So that is a huge hit. And actually, this is great to your earlier questions, like what gets us out of this? And you're seeing the gradual, it's decreasing each year as we're going forward. That's time, essentially. As time goes by, these securities get closer to maturity, the discount, unrealized loss lessens, some of them pay off, and that gradually will float back to zero as these things go by. But also, if rates go down, you will see it lifted. The unrealized loss will go away even faster. So it'll be interesting to see where we end up this year. I imagine that numbers, that deep decline there, or that rise is going to accelerate.
I'll tell you what, Dave, this really is a great chart. This chart really does tell in and of itself a very interesting story. And again, because I don't think a lot of people realize how deeply regional banks got hit with the increase of interest rates and what, kind of what that did to a lot of their investment securities. And like you said, I mean, we've kind of dug this deep hole that they've been gradually working their way out of here over the last few years. But again, I think this chart here really does a great job of just driving that point home and showing, hey, they're coming back, but they still have a little ways to go here. And what I always try to remind people too is that this stuff will never really be an issue as long as there's not a bigger issue. And what I mean by that is, as long as there's not a recession, or as long as there's not something that causes some type of liquidity issue in banks. In other words, a liquidity comes and then that would force them to sell some of these potential securities at a loss. Then it could lead to bigger issues. But as long as that doesn't materialize, as long as the economy still stays pretty good, credit quality stays pretty good, then again, gradually that'll give you the time that we've been talking about to continue to work your way out of this hole. Like like I said, this stuff really only becomes a big issue if you have a bigger issue in the broader economy.
Okay. The only thing I'd say to sort of add to that, you're right, as far as an issue, but the one sort of underlying thing is that these securities are valued at an unrealized loss because they're yielding less. So a bank may choose to like, hey, I'm going to get paid back on these. I know I'm going to get par. I'm going to hold on to it. But what they're doing is they're accepting a lower yield, and it's going to drag on their NIM, and which will drag on their earnings. So you do see some banks deciding to sell, take the loss, so they can invest the money in essentially a higher yielding instruments, hopefully loans, and essentially get their earnings up. So, you kind of have to choose as a banker, choose your poison here. Take the loss or ride it out. But going back to M&A, this created some of the disconnect, because back in that example I gave you, that the banker knows what his book value is. He wants a percentage on that. So one day you tell him his book value is worth 23% less, and you're going to get the money back eventually. You just got to wait for it. They don't really maybe see why they should be marked down. I mean, they know why, but you get the point. Is then they're going to wait it out. Well, I'll wait till the pricing's better, and that's why you see the dip in equity. And now when rates going down, here's the opportunity to get out at the price I envisioned before.
Yep. No, I totally agree with you there. I think your confluence of timing with the rates coming down a little bit, everything's starting to come together. I think I again totally agree with you there. You're really starting to get to a good point where, as you said, people are going to start to see an opportunity there and jump on it. So without a doubt. All right, let's move on to the next thing here. So is there another potential wave of M&A coming here, perhaps in 2026?
Yeah, I mean, I think, the momentum's there. As we talked about, there's pent-up demand. We see lower rates on the horizon, and there's some regulatory easing. And by regulatory easing, we mean that I think there's going to be less scrutiny of some of the larger deals. I think we've seen some of that already. And that potentially the time to approval, which for a while was an issue, where once you announce a deal, you got to live with all the, stuff that goes on until closing, employees leaving and trying to keep everything going at both banks. So decreasing that time from announcement to close is very important. And I think we're going to see bank earnings up. It might just be marginally, but I think as cost of funds declines, you're going to see NIMs increase, and hopefully that'll raise bank earnings. So I think the big question marks for me, does asset quality hold up? And that is actually should be the first three things are asset quality, but then, bank stock prices will follow that. There's a downtick in quality, bank stock prices will follow.
Yep. Let me ask you this. Do you think that, again, going back to the kind of the de novo thing for a minute, like one of the things that you're seeing right now is a lot of like neobanks, different types of, I would describe as almost like fintechs trying to get in on the banking space, trying to get charters through what they call like the ILC chart, the industrial loan charter, that kind of thing. If those players are able to get into the market and they really kind of potentially ratchet up competition for banks, do you see that potentially adding, like, in other words, like some banks just kind of getting scared and just saying like, oh man, we're not going to be able to compete against these guys. We need to just get out. I mean, do you think that could kind of manifest itself in some way?
Yeah. I mean, if there's a major disruption into sort of what the sort of core business is kind of what you're suggesting. Yeah. I mean, that could definitely shake up the market. There's no question about that.
Yeah, because I mean, the one thing I think is I would describe it as a wild card. So there's a lot of conversation right now around the stable coins. Obviously, they're trying to work out the Genius Act, got passed, but they're kind of working on the nuts and bolts of that right now. You've got a couple more. You got the Clarity Act and the Anti-CBDC Act that are sitting in the Senate to be voted on right now. Those could, I call that like the three-legged stool of crypto regulation, and I think you need all three pieces of that to really put the whole puzzle together. But I think the concern there for banks, particularly because the Treasury put out a report on this a few months back, is that the Treasury was projecting that like basically 30% of bank deposits could roll over to stable coins. And the one wild card I have concern with is that again, you have some of these kind of fintech neobanks that might be set up right from the get-go to handle stablecoin. They come in, and if you have a lot of banks that are just kind of sitting here twiddling their thumbs, or maybe aren't real sure what to do with stablecoins, or just don't feel comfortable with the technology, I think that could potentially hurt banks in a very real way, and that might in and of itself lead to M&A in 26, 27, 28. I mean, so that's kind of one thing that's on my mind, is kind of a wild card as to something that could really play into the market in the next few years.
Yeah, I think a lot of banks have done well by sticking to basic blocking and tackling,
Yeah.
and their core business. And if there's a radical change in the environment, it is going to be difficult. A lot of banks have aging core systems, or core systems that may not easily be adaptable. And what you find in the de novos or the newer fintechs is they're coming in with new technology, and they're able to leverage that. So it's going to be very interesting times ahead.
Yeah, interesting. All right, so let's roll on here. So let's talk about your company a little bit here. Can you tell us a little bit about what you guys do, and different, maybe some of the different product lines and things that you guys use on a daily basis?
Well, typically, I mean, we work with financial institutions. Our consulting engagements are focused on profitability measurement, systems operations, issues, and strategic planning for community financial institutions. I'm working on a bunch of strategic plans now. And our advisory practice covers M&A, which includes fairness opinions and stock valuations. And you see on the screen there, I recently, as soon as I joined Kafafian, I worked on a deal with one of our other managing directors, advising Victory Bancorp on its sale of QNB. That's sort of been my wheelhouse.
Nice, very nice. And then, would you mind if I give a shout out to your founder for a minute, Bob? Hey, so Bob is a gentleman. One of the reasons that I sought you out for an interview was because I had known Bob years ago. Wonderful man, wonderful gentleman, and I think he did a great job founding your company. He helped to really build this firm into a great firm that has a great reputation in banking circles. And so I just wanted to give an acknowledgement to Bob, and just all of his hard work and everything that he did over the years to just build a really nice company.
Yeah, Bob has built a great firm, and I'm very glad to be a part of it. Back in the old days, I competed against him on a regular basis, so I'm very happy to be part of the team.
Nice, very good. All right, and then let's go on to, can you give us a little bit about your background here for a minute or two, David?
Well, I just recently joined Kafafian just about a couple months ago. Prior to that, I'd worked for a $11 billion bank in the Washington, D.C. area. Had a bunch of different jobs in the bank, which I really enjoyed. I was director of investor relations, manager data management reporting group, and I was also the FP&A. So, and prior to that, I did kind of what Kafafian did, pretty much very similar firms. So I was president of Danielson Associates, and later I was a managing director at a bunch of other investment banking firms, sort of in the same line of business.
Very nice, very nice. I mean, I love it. Great background, like a lot of doing a lot of different things in your career. It's really really good. Really brought you to an interesting place here. That's for sure. Okay, and then I have a question that I always like to end with on a lot of the interviews, Dave, and that is basically, can you give us, and I know it's already on the screen there, but I always like to ask people, like, do you have a favorite business book?
Yeah, I'm trying to just switch it up here from the normal, business war story type books that you typically see to, some that's very granular. It's this book, Storytelling with Data. At the bank, my former boss, CFO, gave me this book, and typical thing, if your boss gives you a book, tells you to read it, and you're kind of like, I don't know, sits on the shelf for a little while. Then eventually, I'm on a long plane trip, and I say, okay, I've been carrying this book around with me for months. I'm going to start reading it. I picked it up. Honestly, couldn't put it down. It was a fascinating way of looking at essentially building charts and working with data, and it's pretty much just how to make good charts in Excel, and a little bit about understanding the data and how to make things better for the reader and how to communicate better.
And I love it. And I've actually since we talked, before coming on here, Dave, just for our listeners out there, Dave had actually, told me about this book. I went up and picked out a copy of it, and I've actually, given a plug for this book a few times on a couple of the live streams over the last few weeks. It really is a great book. I haven't had a chance to read through the whole thing yet, but I've gone through probably about a third of the book so far, and I think Dave is 100% correct. This book really does a really I would definitely describe it as unique, a very unique job of helping you to think differently about your data and how you are visually representing that and how you are using that to tell a story. And again, very, very unique book in that regard. I think that, and Dave, I think you'd probably agree with me on this. I think a lot of the books that I've seen on this type of topic are dry, very dry.
Yes.
I haven't found this book to be that way.
Yeah, that was my thought when I picked it up, and it wasn't. It was interesting because the problems it was facing was all issues I've had with presenting my own data.
Mm-hmm.
So
yeah, so I love it. No, yeah, and I would tell her.
Next slide, I sort of give you an example there.
Yeah, here we go.
I may have sort of gamed it up a little bit on the one on the left there, but I think we've all seen charts like that.
Yep.
And you can see just reducing the visual noise and just trying to focus the reader on what you want them to focus on.
Yeah, what is the main point? What is the main takeaway? What's the way? If you show that slide to someone, what's the one thing you want them to know and understand and walk away with? Like that's always just be very very focused in on what is the main thing, so which I love. It's great. Perfect. Okay, so now I think that is. Let me go to. Bear with me 1 second here. So we have come off I'm going to pull out of our slide presentation there for a second. So I can't thank you, Dave, enough for joining us today. So let me ask you this: if anybody wants to get in contact with you or follow you, what's the best way for them to do that?
Just kafafiangroup.com, the website. Our team's up there, and you can get in touch with any of us from there. I think that's the best. Or on LinkedIn, of course.
Oh, perfect. Fantastic. And look, I always throw this out to everybody who comes on. If there's ever another topic that you want to discuss, or if you want to, again, love to have you come back again in the future, talk a little bit more about the bank M&A market, or we could talk about de novos or IPOs or whatever happens to be going on at that particular time. But again, always welcome back, and would certainly look forward to having you on again.
All right. Thanks, Joe. I look forward to it.
Thank you so much, Dave. All right, everyone. That was Dave Danielson with the Kafafian Group. I hope I'm saying that correctly. But we thank Dave so much for coming on with us again today. And I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank everyone so much for watching. Have a great day out there, and I will see you again real soon. Thanks a lot.